Hi, everyone. Welcome back to week 6 of the Investor's Guide to Thriving, where, among other things, we'll attempt to understand why exactly 20+% unemployment appears to be wildly bullish for markets. But of course, our real goal is to help you do better with your money so you can live your best possible life and sleep at night. To that end, we've extended the webinar series. This was originally to be the final week, but since Larry's show is still jumping around the weekly schedule on BNN and the economic landscape has never been more uncertain, we're going to continue for the next few weeks at least. Speaking of uncertainty, I'd like to share some thoughts from a conversation I had with an advisor last week. As we were exchanging views of the markets, she wondered aloud if zero rates were going to mean that clients would start questioning the value of her advice. And I said, my personal belief is advice is now more valuable than ever. And here's why I believe that. So first of all, the environment going forward is probably going to be more difficult to navigate than past financial crises. Volatility is back for the foreseeable future, and rates being at zero mean you can't use fixed income for volatility control, not without likely running out of money long before your life expectancy. So I said to her, imagine in today's world, clients have no barriers to accessing markets. ETFs have democratized investing, and they've driven the cost of product to historic lows. I remember when I started in this business, and I'm not that old compared to some advisors, but I remember you could comfortably buy a provincial bond yielding somewhere between 6 and 8%. Now I said to this advisor, imagine that were the case today. Your clients could just go online and buy 50% VT, the Vanguard Total World ETF, for a few basis points and 50% bonds yielding 8% in their online brokerage account. Would that be harder to justify the cost of your advice in that case? I think so. But the world is also, the advice world has dramatically changed since 2008. Not only at ETF Capital Management, the firm that Larry and I started in 2006, but also with our partners on the Quintessence Wealth platform and a great many of the advisors who invest with us through our partnership with BMO, where we run several funds of ETFs. And what's changed is that advice is becoming more holistic. And this in itself is a form of fee compression to advisors because the most successful advisors are investing more and more in their teams and technology to be able to provide a broader, more personalized, and more valuable suite of advice to clients. And of course, that means higher costs, and higher costs mean lower margins. But I have to say, it's better for the client, and it really excites me. The potential for this exploding trend, this intersection of technology and the evolution of advice, making a bigger and bigger difference in the lives of our clients. I got out of this business in 2004 because I was in doubt as to whether or not there was really a value proposition to what we were doing. And I came back to it to work with Larry because we connected through our passion for making a positive difference. Now, another part of this picture is what the industry calls advisors alpha. So you may have read about this. I think Rob Carrick may have written about it. You've probably read about it in the financial media. This is where research has shown that clients with advisors tend to outperform their DIY peers by about 300 basis points. Of course, less the cost of the advice itself. So let's call it closer to 200 basis points. But the main reason for this is that good advisors tend to help clients make better decisions around key inflection points. And that could be wild markets like we're seeing today, or major life transitions that we're all going to go through at some point. So in a year where everything in your life is status quo and markets go up by 20%, yeah, it's hard to appreciate this value, but it's times like this that bring it back into focus. Getting an inflection point wrong can have a massive impact on your long-term returns and your long-term wealth, depending if it's a market event or a life business or personal tax event. And little surprise, I was just reading an article in the Globe and Mail this week that there's been a massive uptick in DIY investors seeking out professional advice recently. We're certainly seeing that trend at ETF Capital Management and Quintessence Wealth. Our client experience team has never been busier. Another big point to drive home is the potential for broader advice to help you save taxes. As the COVID crisis has unfolded, it's great to see governments stepping in quickly with support to help mitigate the damage to the economy. But the truth is, and I believe a lot of you on this webinar today are acutely aware of this, we're going to have to pay for it. World War C, as Larry calls it, has already exceeded the entire inflation-adjusted cost of World War II, and no doubt more spending will be needed. A chilling fact that I discovered recently, in the US, the top tax bracket rose to 94% in the final year of the war, dropping to just 91% after the war ended. And I fear something similar is imminent in the years to come. Tax may well become your top consideration. And this is an area you should be getting help with. If you're not and you're paying for advice, keep in mind that the financial strategy, often referred to as planning, should be part of your advisory service, not an extra cost. Now, if you don't have an advisor and you're doing a great job of managing your own investments, you can build a plan with a fee-only planner. And in fact, we just did a webinar about that on the 28th of April, and you can check out the replay at upotential.com. You might also like to watch a replay of tonight's webinar with Larry or download Larry's slide deck. And if so, you'll want to look out for an email from us tomorrow morning. It'll contain a survey to let us know how you enjoyed today's presentation. And once you complete it, you'll get access to both links. You can sign up for our newsletter and check out past episodes of Berman's Call directly at Larry's aptly named blog, BermansCall.com. Investor's Guide to Thriving comes to you at no cost in favor of two causes that Larry and I really believe in passionately: sick kids and the Baycrest Foundations. I hope you can join Larry and I in supporting childhood leukemia research at sick kids, and we also appreciate your support for the groundbreaking work being done by the Baycrest Foundation into the treatment of Alzheimer's and dementia. For those of you who have made donations, thank you very much. If you would like to make a donation, please use the links in the survey you'll receive after the event, because that's how Larry and I track the donations to match. Thanks also to our sponsors, National Bank Direct Brokerage and BMO ETFs. BMO ETFs have been our partner in ETF education for over 10 years. The ETF itself has been with us for just over 25 years, and they've come a very long way, so there's lots to learn. Here to share some wisdom with you is Kevin Prinz from BMO ETFs.
Thanks very much, Jared. Appreciate the introduction, and always like to partner with you, both you and Larry too. And it's been a good thing we continue together to help educate the end investors. Happy part of that. Let's just jump right into it. What I thought we'd do today is kind of a background for everybody is start talking about some of the actual tools you can use to help navigate these markets, and maybe specifically find out different opportunities in the marketplace too, and specifically different products to analyze. Now, bear with me. These tools are completely free. You can access them directly off our public website. I'm just showing a snapshot of the public website for BMO ETFs, and you're seeing right there in the big circle, that's where you find the tools. Again, they're free of use. What do these tools do for you? Let me go to the next slide here and show you what some of these tools do for you. And you can do this yourself at home and live, but I'm just going to highlight a couple of the key parts of these tools just to help you make more informed decisions going forward. Now, there's three parts of the tools that could help you out make decisions. First and foremost, a comparison tool. I'll spend some time on that in a second. I also want to talk about you can do a tool to sleuth the marketplace, and really it's our screener tool. And last but not least, a proposal generator. I'm not going to have the time to go through all of those today, so I encourage you to take a look yourself, but let's spend some time specifically on the screener tool itself. So what can you do here in the screener tool? What I like about this allows you to take any ETF in Canada plus any mutual fund in Canada and compare them side by side. Now, what I just did here is a simple example of three popular ETFs, the balanced ETFs in Canada, the ZCon, the Vanguard version, and the iShares version of it. And what you're clearly seeing here is that you can see the objectives quite clear what they do. So you can see that as an inside what's going on. And again, you can do up almost 5 at the same time. And again, any fund, any ETF in Canada, you can see the objectives, you can see the costs there across the board. So it gives you that kind of that high level, quick snapshot to help you make informed decisions. But it doesn't just stop there. Let me show what else you can do with this side-by-side comparison. If you move to the next slide, you can actually take a look at some of the performances of the actual mandates, change the different time frames you want to look at, so you can actually see how well these various mandates are doing in the marketplace. And again, compare one to another and your choice how you want to compare. And let me just keep going through some of the depth this tool goes into, because actually one step back there, I want to highlight one thing. If you the depth you can go in here is take a look. If you actually clicked on the ticker on top there, the ZCon there, or the VCNS, or the X, you click on those tickers, That will take you into the next page, which is actually a dedicated one-pager. So not only can you do the high-level analytics on any ETF, any mutual fund out there, but if you want to dive in and get a one-pager deep dive on the actual product itself, see what it's holding, see some of the key analytics of that actual exposure, you can certainly do that too. Now, I'll also highlight for you too, just to make it totally simple for you, what do? We actually embedded all the links to all the respective ETF providers in this tool too. So if you see under the word ETF overview, you actually see there's a link there. It says BMO ETFs, of course, to ours this time, fair enough. But if you're looking at an iShares page or a Vanguard one pager, it'll take you to a link to their website. So if you want to go even further from here off to their websites, you can do that too. Now, I also want to take your time and show you the depth this tool can do. Taking one step back, let's say you want to move away from the comparison tool and do some screener. So for example, last week on the show we're doing with the TMX every Friday at 1 o'clock, we started talking about tax loss selling. And a lot of people said to us, well, how do I find out which ETFs are holding which of the underlying securities? Well, good news for everybody out there. If you're trying to look at, let's say you like a stock, you like a sector, you like an industry, whatever it is, you can actually start to look at this tool, this being the screener tool, to identify the exact exposures. So for example, in that space right there under holdings and weightings, you can actually type in a company and we can identify ETFs that hold that company. Now, a couple of tips before I show you the next slide. The tip actually is, number one, when you're looking at doing to the next holding page, just go back one slide here. Sorry, guys. I just want to quickly highlight, when you type in the name there, you see the circle on the right-hand side. Ultimately, there's a bunch of X's. You just want to close all those off and focus in on the analytics you want to do. Now, I want one more thing to show you too before you click off this page, is that on the top there, you're seeing ETF snapshot, portfolio, ETF portfolio and performance. Underneath there, there's even more metrics you can do to screen and sleuth out different types of ETFs in the marketplace that might meet your needs. So again, talking about the holdings, here's an example of last week. We looked at some of the oil and gas companies. So for example, just click to the next slide. We looked at Suncor, and we looked at specifically which ETFs in the marketplace are holding an overweight in Suncor. And what I'm showing you here is you can actually identify that. Below here, of course, I'm showing you the BMO ones, but I will, trust me, as you move further down the page, we actually show you beyond the BMO ones, all of the actual ETFs out there that have overweight. And all you want to do, if you want to actually focus in on companies that hold a lot more of that, ETFs that hold a lot more of that holding, you just move that line back and forth and it'll help you identify those particular ETFs out there that do that. So really what I wanted to show you today is there is some support out there to help you make informed decisions. If you're looking for some tools out there to do a comparison, again, of any ETF in Canada, any mutual fund in Canada, this is a great tool for you. And ultimately, if you're looking for a tool to help identify ETFs out there with exposures you want to hold based upon their holdings, you can use this tool too. And I just encourage everybody on the line here that take some time and effort and explore the whole power of this tool. I think you'll find it rewarding because it can help you make some informed decisions going forward. With that, I'm going to pass it back to you, Larry, to take it from here. Cheers.
Okay, thanks very much, Kevin, and thanks to all our sponsors, which makes well, there's not a lot of cost in doing webinars versus our more traditional, cross Canada tours. I love getting out and talking to live audiences, and once there's a vaccine for COVID-19, I think we'll most certainly get into large crowds again. But I think a lot about what the world's going to look like, post COVID, and when are we going to actually get back to normal? And it's going to be a long while, folks. So I want to talk a little bit tonight about that. I want to talk a little bit about what the market narrative is all about, and that's really critical to understanding half the questions that have come in this week for the webinar. and the V bottom, is it not? So I'm going to talk a little bit about that. Again, we'll take a snapshot of the current fear and greed in the market, and then we'll do a deep dive on my shopping list. We've had a couple of comments, Larry, you haven't gone deep enough on why you want to own some of those things. So I'm going to dig a little deeper tonight, and then to hedge or not to hedge and how to do that, and then get to your questions. I've answered a bunch of them already on that have come in. I'll try to answer as many as possible. I was looking through my emails today and I came across the Economist magazine cover for this week's magazine that comes out tomorrow, and it says the 90% economy. And that's a big part of why we can't get a V bottom here. But there's a lot of things that are going on here. And one of the biggest things, and what I talked about on last week's show, BermansCall, that now is Friday at 4:30 for the foreseeable future, or until our Prime Minister stops hogging my 11 a.m. time slot on Mondays to do his talk to the nation. Inequality has been the biggest problem over the past decade. And in fact, you can see this, there's two graphs here. One's called the Gini coefficient, or the Gini ratio for families. And what that measures is the dispersion between the haves and the have-nots. What percentage of the population is doing well? The higher that number, the worse your country is at doing it. So a reading of 0 means everybody's equal in society. So we can call that communism, if you will, and not that we want to strive for communism. But when that reading is level 1, it means one guy has all the money and nobody else has anything. You can also call that communism if you look at Russia and look at what the oligarch has there and say, is that system fair? So, we're not going to get too much into the politics of things, but the chart in the upper right corner, and both these charts come from my very good friend, David Rosenberg, and I'll announce right now on next week's webinar, we will have David here live. I will be interviewing him on lots of topics. Please send in your questions ahead of time, and don't miss it. It's going to be a great bullish conversation. And the reason I say bull is because when two bears get together, you get a bull. And there's lots of things to be optimistic about. There's lots of things to be excited about in terms of investment. But when it comes to what the world's going to look like post-COVID, it's a 90% economy. We're not going back to full. You have to understand that completely. And the fact that the markets have rallied back, I got some charts on this, it happens, and it happens a lot. And you can't get caught up in the here and now. And I'm going to talk about the market narrative and recency bias. But this chart in the upper right corner that David put together shows the labor share of income. And since the 1960s and 70s, where it held pretty stable, 60 to 65%, but it's been on a slow, steady decline, and really since 1990, kind of pretty much straight down. And the main reason for that is because income has been generated far more by capital gains and wealth effect that the bottom half doesn't have a lot of exposure to. So income share of the pie is lower. And what that means is there's more inequality. And that's going to be a massive problem if you don't understand what's happening in the world. One of the things geopolitically is that we've seen more polarization. And whether you're left or right thinking, I'm not going to debate. There's merits on both sides for sure. But the polarization is the key thing that I want to think about here, because more extreme left policies. Nancy Pelosi in the next bill is talking about a universal basic income, and Trump on the right is talking about no immigration and higher border walls. Fighting China, everything that plays to the person that's been marginalized by the growth of the world over the last 30 or 40 years that they haven't participated. in a large place, a blue collar typical worker that isn't keeping up and those kind of things. Those same people that are more left-minded think the government should be bigger and should be giving them more things and help, and ultimately the post world at a 90% production level, because we're just not for years going back to a strong economy, is going to lead to higher cost, less global trade. So we're going to bring supply chains back from China, and that's going to hurt China and some of the other markets, and it'll help some jobs here. And while that's all good, labor is more expensive here than it is over there. And even when you factor in the cost of transportation, with oil prices as low as they are and practically, going to stay relatively low for a long time, it was very different when oil was $140 a barrel, and it actually cost more to produce steel in China and ship it here than it did to make it here. So costs are important, and we're going to get two different types of cost push. We're going to get less supply chains and so higher labor cost, and we're actually, until things get restructured, things are just going to get more expensive. So you have in front of us the worst economic situation possible, and that is one of rising prices and sluggish growth, or what's known as stagflation. So that's kind of in front of us. And when you understand in the biggest economic hit ever that this just can't be a V, then you look at this market and you say, it's unsustainable. It's short covering, it's fast money, and ultimately this is really about what the market narrative is. Now, it's the Fed, okay? It's all this unprecedented liquidity, and that's boosted the balance sheets. It's only have more and more. Now we all know, because we all know that when the Fed prints money and there's liquidity and interest rates are low, don't fight the Fed. That's bullish for stocks, right? So that's the current narrative. And so you fall into this behavioral bias called recency. And the recency bias is overweighting the current evidence. You're not thinking about the big picture. All you're looking at is the latest price, and the latest price is dominating 85 or 90% of your thinking, and you want some of that, and it's fear of missing out. And that's what this market is. It's the hope rally. But when you step back and you understand the big picture, and you understand what this 90% economy is, and you understand economically what should happen here, not what's guaranteed to happen, no guarantees. We're analyzing, okay? You can't logically conclude that the economic recovery will be a V. And while the market looks like a V now, it's the most acute V we've ever seen in terms of the depth and speed of the decline. So it stands to reason that you get an extraordinary snapback, because the worst periods are followed by the best periods always. Every market in history, it's proportional. So why should this be any different? And again, when you take that lens, it's not the lens of being bearish, it's the lens of being logical. But there's a very famous saying in the market, is the markets can stay rational far longer than you can stay solvent. But what you have to understand, folks, is we can't time the market. Nobody knows. I'm a guy who specializes in market timing and being tactical. And I'm telling you, you can't time the market with certainty, because we don't know. That is fundamentally core into understanding what you need to do here. Now, when it comes to investing, the narrative, the understanding is risk and return go hand in hand. And the more risk that you assume, your expectation of return is higher. And so you get what in the bottom left here, you get this straight line in thinking about risk and return in your portfolio, except what people realize is this blue curve. in that you only ever need to take smart, moderate risk. And when the risk factors are high, you simply need to take less risk. So when we're at top of cycle, know that you're never going to pick the high. You can't do it. It can't be done. Anybody who tells you they know how to do this is a shill. Outright mitigated shill. Can't be done. And if it can be done and I figure it out, I'm not telling anybody, and I'm going to have all the money in the world. Okay, so I'm not kidding. I'm going to share it with everybody. Anyways, it can't be done. So what sleep at night is, and what I try over and over again to tell people, is that it's very simply, when the market's strong and everything looks wonderful, not unlike today, that's your point of maximum risk and minimum return in the future, except you don't know when. That's the key thing, period. So right now, given my overall view of the world and what's most likely to happen, economically speaking and fundamentally speaking, has nothing to do with price momentum and why people are buying today. I don't know why, but if you listen to the news, they tell you why. And yesterday it was because earnings were good, and today it was because earnings were bad. And that's it. So you have to govern yourself, especially if you're a do-it-yourself investor, to understand this fundamental market cycle. And when things are risky and expensive, you just take less risks. You just have to do that. So let's examine the fear and greed index. Again, one of my favorite indicators here to help me understand and navigate when to dial up the risk and dial down the risk. And when extreme fear is there, okay, this is a 7-factor model. I've said in previous weeks, I'm working on one. I hope to have one sometime in the not too distant future where you can go to our website and look at the similar things, not the same. I think we can do it a little bit better than this, but these are pretty good. So what is current volatility as it pertains to the 50-day average? What is the put call ratio? What are speculators doing with options? How many stocks are going up and down, market breadth? What is the difference in returns between stocks and bonds over a 1-month period? How many stocks are making new highs versus new lows? What is the difference between crappy companies and their debt and good quality companies and their debt? Junk bonds to investment grade corporates. And simply, how far is the market away from its 6-month average? Okay, so SPY, how deviation, 252 trading days in a year, the 125-day average. And I encourage you to use this. And so at the most recent lows, when nobody wanted to buy, that was the time you had to put money to work, especially when you understand the very simple metric that in a recession, the average correction is 29%. We were down 35. Statistically, you have to be a buyer. What you don't know is when the bottom is going to be there. And if you think you can catch it to the day, you're nuts. You just can't do it. Okay, so you know, just get that, understand that fundamental part of markets. Now, you know, I'm excited to have David Rosenberg next week on the webinar with me, because he's a forensic economist. He looks under the hood. Most economists give you a fluffy view of, here's the data, it's fluff. He looks under the hood. When we look under the hood of the market, the equity market, okay, what's going on? The top 20% of stocks in the US are 30% of the index. If you don't own those, you're actually down. So here's a great graphic here. I take the S&P SPW index, so that's the S&P 500 equal weighted, and then the traditional S&P 500 market cap weighted. And so total return year to date, the market cap weighted index is outperforming the equal weight index by 5.5%. You can see that in the total return column there. Microsoft, Apple, Amazon, Google, the big four, 20% Okay, sorry, 15% of the, sorry, 20% of the US market, 21 actually. So if you look at what those are doing, and then you understand what the broad market is doing, you understand that this is not a robust market. This is a rally that's driven by what's working. So Microsoft's still working because people are in the cloud, and Apple's still working because everybody loves Apple, and they got a lot of cash and they can get through this. And they just boosted their dividend today, and they just boosted their share buybacks. And when I talk about companies getting killed because they're borrowing money to buy shares back, Apple doesn't fall into that category, even though they've done it too. They're not going to have to stick their hand out to the government like the airlines and say, we need money. Okay, they've got oodles and oodles and oodles of money. 30% of the Russell 2000 small cap index doesn't make money and didn't prior to this crisis. So what percentage of the small cap index is not going to be making money for the next few years now that we're in the worst economic crush ever? You tell me. So if that's a reason to buy small caps because some guy on TV said value's outperforming and there's going to be a rotation, that's the narrative. Now, if you're a day trader, you can trade the narrative. If you're in one day and out 3 days later, you can do that. In fact, since Ameritrade in the US and E-Trade and Schwab went to free trading, the amount of volume has tripled, I believe. There was an article out on this that I just saw today. Royal Bank, by way of perspective, 6% of the TSX, the 85th largest stock in the world. And if it was a US company in the VTI index, it would be the 62nd largest in that index. That tells you what's going on. Large is winning, small is not winning, and that is inequality. So you've got not only on an individual basis, but on a corporate basis. Now, folks, this, in my view of the world, okay, might be wrong, open for debate, I get all that. I don't think Donald Trump is the president come November. If we go to a left-sided president, see, Joe Biden and whoever he picks, here he's getting close on a running mate. I saw a rumor the other day, Michelle Obama. That would be very interesting. That would certainly lift his stock because I think Joe Biden has got cognitive impairity. I couldn't vote for him. First of all, I vote Republican in general and conservative in Canada, but I think Donald Trump is awful, and I couldn't vote for him on that basis alone. So again, don't want to get too political here, but you know, I follow politics. It drives markets, it's important, and I talk about it. So I think the more left we go, the bigger government gets, the more attack there's going to be to maybe break up some of these big companies. And therefore, do you pay 90 times questionable earnings on Amazon, even though they make, you know, they're going to keep growing and growing and growing and growing? And that's the question. Because one day, whenever that day comes, Amazon trades at 30 times earnings, not 90 times earnings. And so even if earnings double or triple from here, the stock goes nowhere. That's the problem with growth and paying crazy valuations. Having said all that, I've missed Amazon. It's not a stock that I've ever invested in other than through the NASDAQ and some other funds. So own what you like and understand the tools that help you hedge market risks. So I'm going to drill down this week into some of the things that I like in portfolios here, because there's some themes here that are working, and in some cases not crazy expensive. So let me go through those. Now, one of my favorite is gold. A lot of questions have come in on gold. Hopefully what I say in the next little while is going to answer some of those questions. You would have seen a week and a half ago, Bank of America put out a target of gold to reach 3,000 in 18 months. So I look at that and I say, how do they come out with a target like that? Because in my simple view of the world, I go back to the breaking in 1972, we came off the gold standard. That's the bottom for gold. And then I draw my technical lines and trends, and I project out 2 or 3 or 4 years here on the chart. And what I see is up, right? Up and to the right. So that's bullish. The old high, 19 and change, that's a layup to me. We'll test that almost certainly, and we'll go through that. The last big bull move for gold that came with QE, and this, if you've read or some of the research on why they're bullish on gold, is because this round of QE is going to be magnitudes of the previous round. And in the previous round of QE, gold went up almost $1,200 from a base of about 8 and change to 19 and change. That percentage move tacked on to the low a few years ago gives us a dollar move of 17.35. If you draw that line across and project out a couple years, it ties in with the top of that channel. Call it 27, 28, 29. The guys that are saying 5,000, 10,000, they're pulling numbers out of their ass. They don't know. They're selling you a dream. But realistically, where could it go? These are reasonable targets, technically, fundamentally justifiable. Now, when you look at what gold is used for, this is a graphic from the World Gold Council produced in their last month's report that looked at the last 10 years of gold usage. The purple jewelry is half. If we go to new highs here, so look at what happened to jewelry demand as a percentage of the pie in 2011 and 2012 when last gold spiked up to big levels. So it shrank as a percentage of the total. So you have to understand at some point, people in India who use gold for dowries can't afford gold at those levels, right? So jewelry demand is going to shrink as gold prices go up, and that's half. So in order for gold prices to continue to go up, the industrial use or technology use, okay, needs to at least stay the same. There are not really many replacements for gold in the industrial use. It's got very special properties to it, and that's why it's used in some applications in technology. But the biggest two swing factors, investment demand and demand as a reserve from central banks. So what's going to happen to those two? Because that's really going to drive it. The investment demand, you, me, and everybody else that wants to own the shiny metal and the stocks that mine them. That's it, folks. So it's in the world we're going into of deflation and disinflation, and then eventually inflation with all the monetization of debt. In the short term and the longer term, gold has an incredible fundamental demand, because in a deflationary world where interest rates are low and real yields are negative, gold has no competition. And in a world where inflation's ticking higher and bonds are selling off, gold has no competition until yields get very attractive relative to gold. So significantly higher before gold is in an environment of inflation. So in deflation and inflation, gold's attractive. With central banks printing presses like they're doing to combat the deflation over the next couple of years, again, gold has a tremendous runway. I'm going to scope this out more with David next week because it's one of his favorite asset classes too. David is a couple weeks ago put out a piece, and we're going to talk more about what the output gap is. So what the output gap is the difference between what the economy is producing now compared to what it's capable of producing at full employment. David presented 3 scenarios: best case, worst case, and base case. And I don't want to get into too many details. I want to leave that for next week. But the Fed yesterday, basically talked about no negative rates. And meanwhile, here's the trend. So in a 90% economy, David believes that we don't get back to full capacity till 2023. So this 90% is going to be with us for a while. Okay, so this is the output gap here. And that just basically means more unemployment, more drag on the economy, and so forth. So interest rates are going to stay very, very low for a long time. And it's a deflationary environment when you have a output gap. Now, when we were at, only months ago, when we were at full employment, inflation wasn't even able to get up to that Fed 2% target. So, what's going to cause massive inflation that pushes interest rates higher? Okay, what's going to do it? More political moves to the left, but that's going to cause stagflation. It's not going to cause robust economic growth. It's going to cause higher inflation where we still have very stubborn economies, which demands lower yields. We've had 40 years of falling interest rates, and that's not over yet. So the Fed, they talk about negative rates. Coach Lacara, who was the Minneapolis Fed president, is now a university professor, was on TV this week saying the U.S. should cut rates to -25 or -50. There's more room, there's more accommodation. They haven't thrown that out as a policy, and it would not surprise me if nothing else is working that they try it, even though we know from what Japan has done and from what Europe has done is it doesn't work. And God forbid we go to negative interest rates in North America, those precious banks that Canadians love will get cut in half from where they are today. So I'll scope that out more with David because he loves the Canadian banks here. Okay, so we'll leave that a bit for next week too. Technology, what's working? The Internet of Things, large tech, biotech, so the NASDAQ 100, robotics, cloud, software, cybersecurity, 5G, you name it. I love all of this stuff. But I'm a growth at a reasonable price investor, and there's no reasonable prices today. They were close at the recent low. They were, but here's the NASDAQ, okay? So when we had the tech bubble, so the QQQ ETF, it used to be 4 Qs and now 3, started in 1999. And we popped up and the thing literally doubled in about a year. And then it fell, as you can see there, 90%. And interestingly, when we run our Fibonacci's on that decline, we saw a couple very interesting things. We saw the first recovery rally up to 2006-07 there, you can see that, hit the first Fibonacci retracement. We didn't break through that until 2013. You can see it stalled there for about a year and a half, finally broke through in 2013. That purple line vertical that I've drawn on there, that was the US election. So the market got back up to the old high, so the natural resistance from an old high, there just is psychologically, but it broke out with Trump. Everything else just about has corrected back. So excluding the big 5, 6, 7, 8 companies that dominate the NASDAQ, everything else has gone back and retested the levels that Trump was elected at, except for large cap tech. Bear markets, folks, don't end until the baby gets thrown out with the bathwater. And the baby in this environment is what's working. It's large cap tech. So I would submit that the biggest risk today is what's working. And while I love all these things, I wouldn't buy them now. Okay? These are some of my favorite investments for the next 5, 10, 15, 20 years. And I will buy them all, and I will buy them in size, but I will buy them on weakness, not on strength. Because I'm not a momentum. I'm not going to buy something today and sell it next week higher. That's not what a portfolio manager does. Someone who's tilted towards value and growth at a reasonable price. Emerging market. Okay, so the parts of the world that have the growth, if you look at the developed world and you look at the natural rate of growth, population, productivity, the natural rate of growth in the developed world, so all of Europe, Russia, you can bump that in, and North America has very, very meager growth rates, natural growth rates. I'm not talking about this year, the Fed the US deficit is going to be around $4 trillion, maybe 5. 20 to 25% of GDP, 30% of GDP. I'm not talking about growth by expanding credit and leverage. I'm talking about the natural rate of growth. There's parts of the world, sub-Saharan Africa, parts of the Middle East, that have natural rates of growth of 2, 3, 4% of where the North America was, the developed world was coming out of World War II. That ship has sailed. We are not going to see those growth rates again. But that doesn't mean some of the best companies in the world housed in the US big indexes aren't going to service that growth, and they will. And the biggest beneficiary of serving that growth in the emerging world is technology, right? It's services. It's not industrial, right? Now, from an ETF perspective, I want to focus on a couple things here. Frontier markets. So these are the second tier of emerging markets. This is not Russia, Brazil, India, China, the BRICS. The more, even though India is not a mature company or country, or Brazil's more mature but very immature government at the moment. But China is an old economy. Citizens are old. The population is going to peak within a couple of years. China is where Japan was 10, 15 years ago. And they're going to do all the same mistakes Japan did to try to grow. In other words, they're going to step on the gas pedal. They're going to provide liquidity. They're going to create a tremendous amount of debt, and they're going to fall into the same liquidity trap Japan has. So China, to me, is very interesting. They got a lot of people, a big consumer. Chinese consumer is interesting. Chinese technology is interesting. But China in general is a growth engine for the world. The best days are behind us. But some of these economies that are young, Nigeria, average person is like 20 years old. Average woman's having 4 or 5 kids. Now, Nigeria doesn't have clean water for 200 million people. They've got other severe problems. But to invest in some of these places, very interesting. Now, when you invest in frontier markets, make no mistake, I'm not buying this today. There are big risks here still. You're owning financials, you're owning the banks, you're owning the companies, telecom, communication services, you're owning the beer company, consumer staples. That's what you're owning. There's no consumer discretionary in these markets. They're not. So understand that. There's a lot of real estate and REIT kind of exposure in some of these too. These are very, very interesting for me for long-term growth, okay? EEM, the broad ETF that's mostly China. Look at the difference between the currency hedge version of EEM and broad EEM. So the red line on the chart here going back to when HEEM started in 2014. Couldn't go back further because there was no history. That red line is the depreciation, okay? So 7.8% annualized in the strength of the US dollar vis-a-vis the basket of emerging market currencies. It's expensive to be there. So if you bought the hedge version, okay, now the cost of hedging emerging market currencies is expensive, but it added about 2.5% extra return. Now, at some point here, the US dollar gets so strong, and I'm playing right now for the US dollar to weaken at some point in the next number of years as money goes into these emerging economies from an investment standpoint, not just investing in the companies, but investing in the infrastructure and building them out. So that's a very, very interesting theme. in terms of emerging market growth in the future that I think portfolios should be positioned for next 5, 10, 15, 20 years. I'm not buying them today, just to be clear. Now, in the low growth world of stagflation and very sluggish economies, the 90% scenario, I love ZPAY. Okay, so again, ZPAY, highlighted the strategy, the BMO Premium Yield ETF. You can read it, what it does there. Go to the website, BMO website. Kevin highlighted how you can do that at the top of the call. Pull down the fact sheet, understand what this does. It writes puts to buy good companies and earn yield at lower prices. Once it owns those companies, it writes calls at the levels it wants to sell them. So as the markets go up and down, when it goes down, you get longer. When it goes up, you get shorter. All the while, you're earning 5, 6%. And if we're going into a world of sluggish economic growth, the reason this is the biggest position in all my portfolios is because of the 90% economy that I see going forward. And you can see what that BMO Premium Yield did. I'm comparing it to the BMO Tactical Dividend ZZZD. That ETF, it went down a little bit more than mine did, came back a little bit more, and I own a big piece compared to the Purpose PYF has the same kind of strategy, an active strategy, selling puts, buying calls. They're both very similar. The BMO one's done a little bit better, but neither here nor there. Understand what you own. But in the world of 90% economy, those seeking yield, it's not without its volatility. The world fell 35%. The world indexes, these fell 20. So there's risk, but the yield is stable. And the higher volatility, the more premium you get, the better yield you get. So while dividends are going to be cut in many, many places, they're still going to be able to generate, as long as volatility remains elevated, very good yield on these portfolios. And always buying low and selling high. Love the strategy in the world that I see for at least the next couple of years. And then the biggest question, right, to hedge or not hedge. So let's understand risk. Get the question, very good question. I said weeks ago, 5-day move in the VIX below 40 suggests the bottom is in. And what I'm telling you right now is I still am not convinced the bottom's in for the fundamental reasons that I have already outlined. Okay? I might be wrong. Maybe the bottom's in. Goldman Sachs a few weeks ago said the bottom wasn't in, and then they changed their mind, and then now they think the bottom's in. So maybe, okay, and we'll see. But I suspect we're going to get another sell-off, and that sell-off will go to a lower low than what we've already seen. And this is not the time to be buying in, despite the fact that volatility for 5 days now has dropped below that 40. It's not a trading signal, folks. Volatility is still very, very elevated. Make no mistake about that. A VIX reading of 35 or 40 implies a daily swing of 2 to 2.5%. And if you think that's a bullish signal, I got other news for you. Okay. This is the playbook. I think everybody needs to understand that we're in for this kind of market over the next couple of years. Is it going to be one more lower low, 2 more lower lows, 3 more lower lows? I don't know. It's all going to depend on how well we are able to get to 90% in the economy, because first it's going to be 50, and then it's going to be 60, and then it's going to be 70, and then there's going to be another outbreak, and they're going to shut things down again, and it's going to go back to 60 and then go back to 50. And then hopefully there's a vaccine and we can get back to 90 pretty quick. Okay, but we are not going back to 100. That was my doggy in the background. That's okay, the sweet puppy. Okay, so sleep at night portfolios, what we try to do in all our portfolios, in ZZZD, daily standard deviation less than half of a VIX 15 reading. That's what I try to deliver, low standard deviation. And I do that because I make bets when the risk reward is favorable, and when it's not favorable, I move the assets into things that will fall less, but still generate me the yield that I need to deliver in the portfolio. Very, very simple strategy. Here are the 3 BMO funds that I run. The BMO Tactical Balanced ETF Fund that is up 2% on the year. The traditional 60/40 BMO ZBAL ETF that Kevin talked about at the outset is down 2.3% this year. The growth fund that we run for BMO down 1.43% compared to the world index down 12.74. The BMO Tactical Dividend ETF Fund ZZD year to date down 6.6% compared to the benchmark, which is the iShare Global Monthly Dividend Indexed ETF. You have to compare what I'm doing in the portfolio to an equivalent benchmark. There's no other way to do it, down 21% year to date. So we're doing very, very well delivering that sleep at night to investors. So these alternatives, I like these. I use these in my private client portfolios, and I'm going to explain again every week. So there's a new series coming out tomorrow, will be the May series. What I've done here is I've taken the April series from when it was issued a year ago in April till the end of March. It has a 1-year window for that ETF. And so last April was the first of the yearly ETFs, or the second or third of the yearly ETFs that they came out with. And you can see, based on what the market did, so SPY, when it started a year ago, was down 8%, 7.96. That's what, if you bought SPY, you lost 9.82 in price, you got a dividend, and your net return was 7.96. If you brought the 9% buffer ETF, it buffered some of the downside, and that only went down 1.78. And if you bought the ultra buffer, not the ultra buffer, the power buffer, the 15% P APR, that went down 1.35. And if you bought the ultra buffer, you had no loss in the portfolio. How great is that? And it gave you upside until there was no upside, but it did protect you. The vast majority of that protection in the portfolio comes in the last couple of months, okay? You do have mark-to-market risk. You have to understand how options work, but those are good graphics so you get a sense. Now, the innovator ETFs and the first trust ETFs here in Canada, go to their website, read up about them, lots of education. But here's what I do, like buy the stuff you own. You don't need to sell and go to cash. You need to learn how to hedge. And options are the best way to do it. You can do it with options on the index if you don't want to get put the underlying, or if you want to get exposed to put, you can do the ETF versions. Doesn't matter. So I took a snapshot today at 14:41, so this afternoon, as I was preparing, updating the slides here. The S&P at the time, 289.16. You can see the last traded price there. So the 289 put, the at the money put, was trading at 28.49 ask with an implied volatility of 28.87. So that's the VIX. And the at the money call, so that's called a caller. When you sell a call to buy a put, it's called a caller. It's the same as going short the outright ETF. It's called a synthetic short. The difference in price, the main part of the difference in price between the put and the call is the dividend. Because if you short the stock, you got to pay the dividend on the dividend dates. Okay, and that's why the prices are different. So if you look at the Black-Scholes model, you understand a little bit more about what I'm talking about here. Very simple. There's all kinds of strategies. I don't have time to go into all of them, but we've implemented these caller strategies on the BMO funds to even further add more sleep at night experience to those portfolios. So when the greed factor is high, You can still own the great stocks you like, the great ETFs you like, but learn how to hedge the market risk. And these strategies can be done for no cost, meaning very, very little cost in terms of if you buy something and sell something for the same price net, there's no cost. Okay, so they got to be done in margin accounts, and you got to learn a little bit more about how to do that. And then when the CNN fear index is high, like it was a month ago, you lift the hedges and then you expose your portfolio to all the upside bounce, which is what we do in our portfolios for clients and why we've done so well. Okay, let's get into the Q&A. So we got half an hour left, and hopefully I can get through all of these and do some more of the ones that have written in tonight so far. My friend Rosie's predicting a 60-cent Canadian dollar. Do you concur? I don't think we're going to see one that low. Again, I'll hash that out next week with Rosie live here on the call. But I would argue that we don't see that. He's got a much more dire view than I do on Canada in particular. But I can tell you that if we maintain our current government and there's no support for building pipeline capacity, we are going to see a permanent impairment to Canada's ability to compete globally in the energy space. It's our biggest export, and it's criminal in my mind. And maybe the market reflects that and we get close to 60 cents, but I don't think we'll see that. Okay, so there's a difference between Rosie's view and mine, but I'd like to hear more about what he has to say because he might be right. The developments this week, including the announcement of the gradual reopen of the economies. And so the gradual reopening, has it changed my opinion? No, because we're going to reopen. But ask yourself the question, Roman, are you going back to a restaurant if you have to wear gloves and a mask to eat and have your server come with gloves and a mask? So the answer might be yes for you, Roman, but I can tell you it's not yes for everybody. It's not yes for me. I'm not going out for dinner with friends, because you go out with friends. You go out to celebrate with your other half. You go out for just to get, so you don't have to cook that night, right? So you go out for lots of different reasons. But are you going to do that if you have to wear a mask? The answer is no for most people. So those restaurants, I think 20 to perhaps 50% of restaurants don't make it. And what's that going to mean? I mean, the bankruptcies that are coming, $40,000 loan to a Canadian small business is great. Thank you very much, Mr. Trudeau. It's not even close to being enough. And it's a loan. 30,000 is a loan, not even close. The longer this lasts, so we got to get a vaccine. We're not going back to anywhere near full capacity anytime soon. Don't let the recency of the market move. We were always going to get a violent snapback. There was never a question of that. The only question was timing and how high. That was it. And so now we've seen us get to these big retracement levels, market starting to fail. Now we'll see. We'll see, Roman. But I'm not going to make that bet, and it hasn't changed my opinion. Rosie tweeted, we're heading into a recession. No, I think he said repression, not recession, but he's calling this a global repression. So like a depression, but not a recession, and he's calling it a repression. So should we buy gold? Yeah, I love gold. I explained why I think gold's a winner here. So William, hopefully I've covered that off for you already. Why we've been on fire. I talked about the narratives. I've talked about the narratives. We're hearing from trading desks. Listen, people get forced into the market. When you're a fiduciary, you have clients and they ask why. Market's going up, why aren't I in? It forces the portfolio manager, whether they believe in a rally or not, to buy. It does. It just does. It's just a thing, Allison. It's just a thing. So I'd stay defensive. Stay defensive. Don't have any regrets. Allison, the best of us didn't get this perfect. Okay? and we won't the next time. So the question is, Allison, have a playbook. Know that if the market goes down 29% from the peak and you've been defensive, that you got to put some money to work. For you, Allison, that could be 30%, it could be 50%, it could be 70%. Allison, I know nothing about you. I can't tell you how much money you should put to work. Maybe it's 150%. Maybe you're a leverage junkie. Being so conservative, it doesn't sound like it. But those are the things that you need to know about yourself. You need to have a plan. 99% of people in the discount advisory channel don't have an investment plan. They're watching BNN, they're watching CNBC, they're looking for tips. They don't know what to do when things happen. Okay, so what I try to do in all these seminars is not give you a tip. Don't tune in to Larry on Berman's call and on if you're looking for a tip. Now, by all means, I'm going to give you ideas, but don't look at them as tips. Try to learn with me. Okay, so what, Allison, my mindset, I'm an 80-20 guy. 80% of what I do very, very well, and 20% I can improve upon. And so we go through a cycle like this and we learn. And what we learned is, well, maybe we should have put a little more money to work, but we didn't think the rally would be this high. I actually started hedging things around 25, 26, 26.50 into the box, the retracement box, the 38 to 50% retracement. It shouldn't have got this high, but it did. Okay. Every time's different. Markets rhyme. You just don't know. So you have to have a strategy. And so what did we do as the markets went higher? I sold a little more and got a little bit more defensive so I can make money when the markets pull back. What if they don't pull back, Larry? What if it keeps going and makes new highs? What, you got to be okay with that. If you're going to be active, Allison, you have to be okay with being wrong. Because if you're not, you're going to chase the market, the fear of missing out. The market's going to force you in at the worst possible time. And I believe that's happening now with a lot of the free trading, to be honest. By printing unlimited money, can the Fed create an endless bull market in stocks? So should we just all be bulls and ignore the damaged economy? Is it possible? The days of major recessions and depressions are over. Well, David, not only is it possible, that is what the central banks and the governments are trying to do. The whole Fed model is this financial conditions index and their dual mandate. It's all about trying to stabilize. But we're in a recession. In fact, we're probably in a depression. Most people just don't know it yet, and they couldn't have prevented this no matter what. And the unprecedented liquidity is not going to fix things. They've just thrown more debt at it. Don't fight the Fed, don't fight the Fed, don't fight the Fed. You get a face-ripping rally. So that's what it is, David. Govern yourself accordingly. So and understand the environment we're in. There's no. Powell said it yesterday in the press conference. There's no limit to how much money we can print here. He didn't say it like that. There's no limit. There's no limit to the Bank of Japan. And what has that done for their economy? It hasn't. And if you don't think the rest of the world is heading for that, you don't understand how economies work, right? So that's why we've got a damaged economy. The only recovery in the last decade, the multiple expansion, all of that is fake. It's share buybacks. It's the reason Warren Buffett, I'm dying to see Berkshire's report because I want to see what Warren bought last month, right? Warren had more cash than anybody. So anyways, okay. Terrence, I have a sizable cash position. Everyone's got wondering if corporate results. So it's the same question. The other shoe going to drop? Yes, but Terrence, there's better things to do than sitting in cash. Now, for many people, that might be their only option, but there's better things to do. You can still own great companies that pay you good dividends. In my growth fund right now, half of it
it
is in ZPAY, not the BMO one, the private client one. Half of it is sitting there clipping a 6+% coupon, and my market risk is hedged with options. That's way better than cash, folks. Learn how to use options. I can't say it enough. Doug Gilmore, Mr. Gilmore. As of the opening, it appears this 5th consecutive day for the VIX to be, okay, so VIX below 40. So I explained that already. No. Gradually re-enter, no. I think we're making lower lows here. I'm almost certain of it. How long it takes and how it plays out, Dougie, I don't know. I can't tell you that. If it's next month, listen, it's COVID, right? We had the perfect storm of economies opening, remdesivir, spending, Fed, unlimited support. Yeah, that's a lot to be excited about. But has it fixed anything? There's no vaccine. The world's not going to normalize until we get a vaccine. You just have to understand that. Forget VIX. I explained this the first time I talked about it. VIX above and below 4 is not a trading signal. It's an environment. And last time around, 40 was the number. Maybe this time around it's 30. I don't know. Okay, so Dougie, you kind of got to understand a little bit about that. Dr. Ryan R. I've said I'm long-term bullish on India and recommend the India ETF. Do you prefer India to Z? So INDA has better trading liquidity than Z bid offer spreads. Remember, when you're trading an emerging market, and I didn't mention that on a slide, and I had that bullet point, and I should have, they're closed when we're open. Spreads are wider. So I would rather, if you're trading, trade INDA. Effectively, the same basket. Some use ADRs and GDRs and slightly different, and you got to look at that a little bit. But you know, if you're buying long-term buy and hold and you want it in a Canadian dollar account, you're still exposed to the foreign currencies within it. But ZID is fine by me. If you're going to trade it and be active in it, INDA. You can't trade ZID. Linda mentioned I'm very bullish on gold. So I've talked about gold. You buy gold on every pullback we get. Should you wait or should you just jump in? We had a pullback today. It's below 1,700. Just buy it. It's going higher. Will it go to 1,600 before it goes to 1,800, Linda? I don't know. We definitely had some month-end rebalancing from risk parity funds. So gold's had a rally. Bonds haven't rallied much. Stocks haven't rallied much. So what did they do today? They bought some bonds and they sold some gold and they sold some equities to rebalance. Okay. So does it last through tomorrow? I don't know. But the runway for gold here is great. Yeah, I liked it better at 1470. I loved it 2 or 3 years ago when I first started talking about it on BNN, when gold was at 1150, 1200. I loved it down there. It's not as attractive risk reward here, but still got a lot of upside. Maybe you want to look at options on how to play it that way. Ford, what do I think of Ford? So I last time I owned a Ford was 25 years ago. Does that answer your question? No. I think Ford sells an awful lot into the rental car market. That's going to be impaired for a long time. They make the best trucks, you know, the F10, F-150s and all those are. So, you know, what do I think of Ford? I don't know. I don't know. I wouldn't buy it here. I think we've got to see the economic pain. I think for the marginal buyer, they're not buying any new cars for years here until they get their jobs back and so forth. So the lower end buyer, that's the more marginalized person, is typically going to buy a Ford versus a higher end car. No disrespect to anybody, but that's kind of Ford is not a high end vehicle in general. It's probably a laggard here. They're not overly strong in the electric space compared to some of the competitors and so forth. So those are some of my thoughts, Rob, on Ford. New wave of corporate losses, cancellation of dividends, the advent of day trading to try and regain supply portfolio growth. I'm not sure what. Other than the drop cancel on dividends, is this the advent of day trading to try and regain? I'm not sure what that means, Richard. I'm sorry. With that question there, I'm just not clear on that. I'm sorry, I'm going to pass on that one. James purchased the inverse 2 times bear. I would not be using the leveraged ETFs at all. We've seen too many times here that we've seen very extensive moves, and these ETFs rebalance daily, and they can get you into lots of trouble. I have no problem using single inverse ETFs. I don't like the leverage ones. However, if the question is, if you're a speculator and you're okay with it being short the S&P 500, 2 thumbs up for me on that. Sitting on cash and timing the market's not a great strategy, but that's the position I am in. I hold some ZZD. Well, thank you for that, and want more. Market has me frozen. It's not easy taking the motion out of it. No, it's not. Everything is very irrational at the moment, but that's a bear market, Bruce. We are in a bear market. Make no mistake about it. Bear markets rip your heart and soul out before they bottom. And believe me, Bruce, my sentiments in January, February, and into March of 2009 were, is this pain ever going to end? And until we get to that, the bear market is not over. Okay? Now, are you going to be able to time it perfectly and catch the bottom? Probably not. I'm not going to, certainly, but if you need a yield, because you can't get it in cash these days, you're going to get that 4% plus yield coming off of ZZZD, and I'm going to do my very best for you to protect it. There's going to be some volatility there, but so that's, Bruce, just some thoughts there. Chris, for investors with cash sitting in a broker savings account, mutual fund, current rate 0.25%, what happens to accounts like this if we go to negative interest rates? So money market funds get screwed up big time with negative rates because they hold money market. So if T-bills are generating a negative return, then the money market instrument will be screwed. So money market funds in Europe have a big problem, and let's just hope they don't go there. You would just have to leave your money in your account. Now, the transmission mechanism. So as an institutional investor, a couple years back, I wanted to hold some euros because I thought we were going to go from about 105 to 115, and it actually went to almost 125. So I bought euros, and at the time, negative interest rates. I had to pay the custodian 65 basis points annualized to hold cash. Now, that never happened in bank accounts because, God forbid, banks charge you a fee monthly for your account and they charge you interest. Never mind paying you no interest on your cash balances. So negative rates screw up banks big time, and this is why when rates go lower and they're negative, why European banking stocks and Japanese banking stocks are 70, 80, 90% below their peaks of yesteryear. We don't want that here, and it would screw up money markets, and there's a huge money market business, and that, if nothing else, is the main reason why the Fed and the Bank of Canada will not go to those policies, because the money markets here are much more broad than they are in Europe and in Japan. Ken's looking for a 5-star health and science ETF. He's asked BMO if they have a health and science ETF or mutual fund. They do not have one. Can you tell me why? I'll leave that question for Kevin ultimately, but there are some other good ETF providers. You might want to look at the Evolve Life ETF. That's kind of like life cos and pharmas with a covered call overlay. There's the healthcare. It's not the healthcare providers. The Harvest Income Healthcare Fund. There's a couple good ones out there in Canada. Go to the ETF screener that Kevin highlighted and do a search on healthcare. And that will, in the US, go to ETF.com and have a look there. All right, lots of questions tonight here. Pierre asked, he's recently invested 10% in ZZZ. Well, thank you. You're pleased. So am I. Thank you. I have another 10% of my holdings in Berkshire. Well, I got to say, Pierre, that you're putting me in your portfolio with Warren Buffett. I'm honored. And I have 40% in other stocks. Should I consider adding to ZZZ to diversify more? So I you know, yes. The considerations are, what if my market views are wrong? I get it wrong in terms of I'm not perfect, a third of the time, but most of the time I'm pretty on the money, and ZZD is going to deliver sleep at night, global exposure to yield and dividends. And if that's what you want, you're globally diversified. You're diversified across asset classes. You have option strategies. There aren't any more diverse portfolio managers in Canada than what we try to do in those portfolios. What settings on an RSI chart or any chart are fast enough to predict the volatility occurring today? What do you use? Wayne, I learned a long time ago that in high volatility markets, almost nothing works. It is just that we are in unprecedented times, and as long as VIX remains elevated, and when I say elevated, I mean in the levels we are today and higher, not specifically 40, but elevated, that there's not a lot of technical tools that are going to give you brilliant trading signals. There just aren't. RSI 14-day, it's fine. If you want a day trade, you go down to half-hour bars, and how many half-hour bars in a trading day, right? Approximately. So you kind of do that math, and a 14-day RSI is on a half hour. That's a 1-day trading range, and you kind of get the sense. I like to line up my indicators with the time frame I'm trying to trade in. If you're looking at weekly charts, a 14-period RSI is 3 months, right? Daily, couple weeks. During the day, it's about 1 trading day on half-hour bars. So there you go. Just to give you some guidelines on some of the indicators. Gear them towards the time frame you want to invest in. Don't worry about the noise. Chris asks, thank you for doing this. Well, you're welcome. I enjoy doing it, and I love teaching. If that doesn't come out, I want to emphasize that enough. How do you react when the market's doing what it's doing, optimistically forecasting an immediate and sustained recovery with a little longer term impact, obviously contrary to I've talked about it, Chris. I don't really have a lot more to say on that. I think you got to step back away from the recency. You just do in an environment like this, and think big picture and strategic and what's most likely outcome, and recognize that even doing that, you might be wrong. I found the ETFs you've been recommending well managed with interesting objectives. Most of them have low trading volumes. So although I'm interested in investing in them, I'm somewhat concerned about their liquidity. Can you explain why low trading volumes of those ETFs would not impact their performance? So Armin, The ETFs have the liquidity of the underlying stocks, and some newer ETFs that may have been only out a year or two in great asset classes, great thematic ETFs may not have a lot of following, may have a bit wider bid-ask spreads. So if you're going to use them for trading, Armin, then just if you're going to trade, just stick with the liquid S&P 500, NASDAQ, those names. Don't try to trade these thematic ones. They're great for investing, scale in, scale out, put limit orders in, never market orders, and don't worry about the low trading volumes. What you have to worry about is the absolute size of the ETF. So if after a year, more likely 2 years, if there are no material assets in the ETF and the ETF provider is in a Vanguard, a BMO, an iShares, a big company, then those ETFs are ultimately going to close. And that's the formal part. I've got a few minutes left. Let me go to some online questions here that I can take, and then I'll do the final wrap. Question here on EMLC from Matt. Emerging market debt. Can you talk about how those exposures will react if countries own default on their debt? So, good question, Matt. And I do own those ETFs in all my BMO funds, EMLC. So the play there is on currency with a 7% yield, which I like right now. The high probability default when emerging markets default is a default in the foreign currency debt, the US dollar debt. These are all local currency debts. They can print money in their local currency and buy those bonds back, not unlike QE, at the expense of weakening their currency. And they'll all be okay with that, except for the US dollar debt that gets more expensive for them to pay back. So EM bonds that are denominated in US dollar holdings are far riskier than the local currency debt. But when you buy the local currency debt, the currency risk is then transferred onto the unit holder. And at this point, remember that chart I showed on EM currencies? We've had an 8% depreciation over annually for the last 7 or 8 years. The US dollar is very expensive versus the basket of EM currencies. I love the exposure here to EM currencies, okay? So I get a 7% yield. I love the exposure. I don't know when it's going to start working for me, but when it does, I'm going to make bags of money there. When stocks get cheap to bonds, I'm going to sell EMLC and I'm going to put that money into emerging market equities. That's the second part of that trade. Matt, thanks for that. Okay, I've only got a couple minutes left here before I wrap, so I can't get to any more online web questions, but by all means, please, for next week's call with Rosie, send in your questions. I don't get to as many on the online sessions as I'd like to, but we try to populate the webinar with as many of the online questions that come in, so take the time, write your questions in when we send out those requests and surveys. You want to learn more about the 3 BMO funds, including ZZZD, go to ZZD Portfolios. If you are interested in having me and my team help you with your financial planning, Monique did an excellent seminar this week. You can see it at UPotential, and customized portfolios of $1 million or more. Please click the feedback form. Someone from my team will reach out to you, or go to our website at etfcm.com. For the ladies out there, if you want a bit more of a focus from the lens of a woman in finance, Golden Girl Finance is all about talking to women from a different viewpoint. And for the other portfolio managers out there and financial advisors, have a look at Q Wealth. Folks, we're out of time. Thank you so much for tuning in this week. We'll see you next week. Please, please, please consider supporting one of our charities, Cancer and Leukemia Research at the Sick Kids Hospital, a charity near and dear to our hearts, mine and Jared's daughter in particular. and for my parents and for all the other folks out there who are having cognitive problems with dementia and Alzheimer's. The Baycrest Hospital is one of the world leaders in brain science research, and I'm an avid supporter. And I'll challenge you to $20, $50, $100, $500. I got one donation this week for $99. I love it. Do the $99 challenge. I'll be thrilled to match it. Thanks, everybody. See you next week.